Markets certainly sold off on Friday to close out the week, month, quarter, and first half of 2024. But even with the selling pressure, a key technical level on the charts continued to hold up, and that level will really become the top focus for this upcoming week. Remember, markets will be closed on Thursday for Independence Day, and don't be surprised if Wall Street extends their vacations out to Friday. Welcome to the Trade Brigade weekend episode. My name is Matt, and I want to show you that level, explain why it's so important, and cover one bullish divergence, which in my opinion is also supportive of the same exact level. As always, check out the links listed down below in the description, hit the thumbs up button, and subscribe, and stay tuned until the end of today's show. I've got 4 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So kicking things off on the SPY monthly time frame chart, now that the June bars have officially closed out, what do we see in terms of candle structure and location? In terms of structure, solid green-bodied bar with, yes, a little bit of an upper wick and a little bit of a lower wick. So on the weekly time frame chart in just a moment, we'll see this as back-to-back inverted hammers. There's the potential for some sort of pullback to unfold here, but if we're going to read into the upper wick, we need to remain sort of unbiased and also read into the lower wick. This would suggest that buyers stepped up near the lows of the monthly range, and if we segue this directly into location, this is happening over the top of a monthly balance range right here. On the bar-to-bar count, there's a huge higher low as well as a higher high, and the buyers were still able to close in the upper third of the monthly range, completely outside of the prior monthly bar. This does strike me as bulls on parade on the higher time frame charts here. If we're thinking about the trend, of course it's up. We have lows, higher lows, and these are soft monthly higher lows. Remember, just like on a daily time frame chart, we need the smaller time frame to actually flip into a downtrend. We didn't really get a weekly downtrend in April, and we have gone on to produce a brand new higher high. So the market could pull back here, and the uptrend will remain intact out of the monthly time frame chart. If we're thinking about possible pullback areas to pay attention to, the highest one is going to come from the low of this pullback up to the all-time high. It's the bottom end of the bull flag consolidation if you're thinking about it through the lens of this pattern right here. That level is loosely around 500, the nice round figure. If we come in from the bottom of the 2022 drawdown up to the most recent all-time high and extend this 38.2 off to the left, it's great confluence with the previous all-time high, and that's closer to 475, 473 here. That would also keep the monthly trend in the upward direction. Now, what about upper targets? Because we are moving into blue sky territories, we are in an uptrend. What if the market were to continue higher? Let's take a look through the lens of the cup and handle measured move, because this is the closest measured move. We already know that we hit the measured move from the pullback low of the cup and handle. So what we'll do is we'll come from the base up to the high of the cup, and we'll stack it directly on top of the cup. The measured move here is certainly within striking distance for the month of July if the trend continues in the upward direction. Notice that the range of this monthly bar would certainly put us up towards that, let's call it 565. Just for round numbers' sake, we'll even round down a little bit. That could be a measured move target in the upward direction if we're searching for things. If this, as we mentioned earlier, is also a bull flag, we could take the measured move from here to the top of the flag to the pullback low, and this measured move is much closer to 610. If you watched our previous monthly analysis, you know that there's also a trick up our sleeves coming from the sickness low to the previous all-time high to the 2022 drawdown low. You're getting confluence out of both of those bull flags around 610. Now, the argument is not that we go here for the month of July, the month of August. This is something that we're focused on for potentially the back half of 2024 if the monthly trend can remain in the upward direction. So that's a great looking area. You could also undercut it a hair and just say, nope, it's going to be 600, the nice round figure. It's a psychological number. That would be reasonable as well. But as we're moving into blue sky territories, I think it's worth having these things in your back pocket. Let's take it on down to a weekly time frame chart. Let's continue to get granular here and describe the upper wick of the monthly time frame, right? So in terms of structure here, we'll go through the same exact rundown. What do we see? It's definitely more of a bearish candle. It's an inverted hammer, and it's got a technically red body on it. I would say that the open and close are hardly changed from one another. However, the close is slightly underneath the opening print, giving the bears a bit of an upper hand. And this is a back-to-back inverted hammer. So clearly, at these highs, we know that sellers are stepping up and the buyers are really struggling to produce trend continuation out of the weekly time frame here. Now, it's It's a great segue into, of course, we could talk about location, right? Technically a higher low as well as an equal high. So pretty neutral on location. I would say bearish on structure, but the overall trend remains in the upward direction. You have lows, higher lows. Here you had highs, higher highs, and these are the highest highs in the trend cycle. The key level that we're really describing in the intro is the bottom end of the 2-week balance right here. If you could flush underneath the inverted hammer lows, it wouldn't be unreasonable for a pullback, and one of the locations I would be thinking about is actually right here, the breakout area in the first place, and that would keep the trend in the upward direction, right? If this was going to offer a big-time weekly higher low, and to give you a loose area of what that number might be, something around 532.60. We'll get more granular on the daily in just a moment, but let's take a look through the lens of the fibs, right? Coming from the bottom of this pullback up to the high, pretty darn spot on with a 38.2. What do the anchored VWAPs on the weekly time frame chart have to say? Over time, this is again going to act as confluence in this area. But wait, there's more. It gets better. Let me show you this as well. If we take a look at the weekly volume profile, and let me actually reduce this to like a 1-year chart here, so just so we can see things with a little bit more detail. Notice that the bottom end of the back-to-back inverted hammers is a high volume node. So if we were to break down underneath that, what are we falling through? A low volume void. And where's the next high volume shelf? It really steps in closer to the top of the breakout point here, which as we just described is closer to, let's just round it off there to 530. So is it reasonable that a pullback could happen underneath the key level that we've been talking about so far? And that number, by the way, is 543.20. These lows right here, 543.20. If we're underneath that on the weekly time frame chart, it's not unreasonable to be looking for some sort of higher low. So all things considered, highest time frame chart monthly remains bullish. I would argue that the weekly time frame chart is struggling to produce continuation in the upward direction. That doesn't mean that the chart is bearish, but it means that a pullback could occur to achieve and sort of search for a weekly higher low. When we get to 530, I would put my thinking cap on and say, okay, if we find ourselves here and buyers are stepping up, if we get a weekly hammer candle, if we get a daily double bottom off the top end of this range, I would be thinking about weekly higher low and trying to trade back in the upward direction to continue the monthly trend, which as we just covered is certainly in the upward direction. Let's take it on down to the daily time frame chart and firstly evaluate this week's expected move. If you're not familiar with this study, check out the video tutorial in the top right-hand corner. If we're contained by the upper bound, the number's at 550.27, implying an equal high to the all-time high, kind of neutral on the upper end. And if we're contained by the lower bound, the number's at 538.24, certainly implying a lower low. And this is where we have to have a stronger discussion about trend, because as we've been counting, we have lows, soft higher lows, soft higher lows. We did accomplish an hourly downtrend in this segment of the chart right here. So this is your last set of daily higher lows. Now, of course, considering that the hourly trend starts to cement daily trend inflection points, what did we have in this segment of the chart? Certainly an hourly uptrend emerged, so this equal high puts the daily trend in more of a balanced state, noticing that we're trading right back down at the low from over here. You have equal highs and now you have equal lows at 543.20, which as we mentioned on the weekly, is the pullback level in the first place. If we're thinking about what happens if we break this level, technically we bring in a lower low from here to somewhere down here, right? And now we're suddenly in a daily downtrend. So is it possible that this emerges as a double top? The answer is absolutely, causing the weekly pullback, getting us underneath 543.20, looking for the CPI gap to close, and then when we get down, if we get down towards this area, thinking about the opportunity for a reversal back in the upward direction to cement your weekly higher low. So that's the navigation through the time frames in my view. If we're thinking about the structure from the Friday session, it's fairly concerning. Like, let's call it for what it is. The market developed a very short-term hourly uptrend in here, coming off of a daily higher low in an overall uptrend. Remember that this pullback here was from the highest high in the trend sequence. So the fact that we opened here rallied to test the high, and then closed all the way back down on the lows. First of all, this is a bearish engulfer, but the upper wick makes it much worse, suggesting that there is no price acceptance up here. And we'll see why on the hourly chart in just a moment. There should have been offerings of hourly higher lows above here. Again, we'll get to that in just a moment, but the bearish engulfer closing right back down at the neckline has me somewhat concerned about the opportunity for a daily double top. If we break down through the neckline, we'll call the chart for what it is. It's starting to develop a daily downtrend. Underneath that 543.20, I think we've been very clear about that as a key level, right? That is the key level we were mentioning in the intro. We're starting to target the bottom end of this 3-day balance. That's the beginning of the CPI gap, 540.32, and underneath that, we're starting to think about the CPI gap close at 537. It's a shortened holiday week. We may see some very slow and sluggish activity, so we'll update you on maybe Tuesday after the close on whether or not we need to start thinking more aggressively about these levels down below. Keep in mind that I would argue the weekly line in the sand for that high or low, the ideal location, would be over the top of this balance range from in the past, 531.40, top end of the balance, bottom end of the soft higher lows from over here, right? Weekly pullback to accomplish this, daily trend reversal back in the upward direction gives you your weekly higher low. You're in a daily downtrend to accomplish that though, right? Any consolidation inside of this range, I think we have to take it at face value. This market's very choppy. There's a lack of momentum in the upward direction. I haven't really seen aggressive sell side momentum outside of Friday's session off of those lows, so I would still be cautious about getting aggressive to the downside. Let's talk about how this breakdown actually plays out on the hourly time frame chart. If you're a seller here, how do you want to participate in this breakdown? In my view, it's pretty clear. So first and foremost, notice into Friday's close, there's actually some support off of this exact level. We didn't really see sellers close it dead on the lows with the suggestion of follow through immediately on the Monday session. So if we're opening in range, I would not be a seller through the breakdown of this level because we know that all of the evidence behind us still suggests that buyers, dip buyers most importantly, are still here in this market, and we haven't really seen aggressive sellers. The whole argument of Wednesday's episode was that we made a lower low, but we got zero follow through in the downward direction, and obviously we've got ourselves an equal high. So trying to not lean too heavily into the sell side, you need confirmation before going short. What would that look like? Of course, some sort of breakdown under the key level we've described so far that yields a lower high. So you're actually back in an hourly downtrend because as of right now, you had lows, higher lows, and along the way, highs, and higher highs. On the daily chart, we had mentioned that the ideal outcome on the hourly would have been consolidation up here, then looking for follow through into blue sky territories. Okay, you didn't get perfect consolidation over 548.35, not the end of the world. Let's look for a higher low here and then move back in the upward direction. So no buyers stepped up there, no buyers stepped up here, right? So trying to remain balanced, but overall, in this range, I think we're neutral. This offers your short, and this is ultimately the target down below. Risk reward that you're trying to navigate is something that is this, and then balloons into better risk reward, something like, I don't know, that could turn into a 4, 5, 7 to 1 risk reward ratio underneath 543.20 to close the gap, ultimate target down at 537. If the market supports over 543.20 and we're consolidating in this range, I would be neutral there. I really wouldn't take the stance of an aggressive seller. I would think, all right, if there's a higher low here, maybe the hourly trend drifts back in the upward direction. Would you want to long that? Probably not. What do we say in the midpoint of a range? Do not exchange in the midpoint of a range. There's a number of those sayings, right? It can go either way, but not really interested anymore in this area. The market's proven to us that it's choppy, sloppy. So your best trades out of the spiders really come from this range expansion to the downside or this range expansion to the upside. I would be partial to a higher low over 547, simply noting that that is the opening print of Friday's session where that breakdown started to emerge from. So in here, a bit more neutral. I would start to lean on the bull side if we're over 547, looking for another test at that all-time high. And I do want to remind you that the overnight all-time high still stands here at 551. Right? So this is technically the improper end of the auction. You don't usually see it happen this way, where this is going to mark the all-time high, and then there's this nasty drawdown. Oh my goodness, markets are going to zero. Monthly downtrend is around the corner. It really doesn't happen that way. So still carrying forward that the overnight session high is weak from the holiday session of what is now 2 weeks ago. Let's bring out the intraday anchored VWAPs just to show you that these are sort of clustered around the midpoint of the consolidation. So I'd really like to see the clearance of all that, again, to remain bullish or flip back to being more aggressively on the bull side over 547. And if we're underneath the lows here, you might run into some trouble with this, but I would tend to think that all of this overhead supply weighing on price would really open this trade up to the downside, and I wouldn't be overly concerned with the anchored VWAP in that area. Just something for possible consideration. If the market really balances out in here and this plays catch up, so this is like one of the ways in which I would use this. If this is then confluence and then you break that, absolutely an even stronger short indication, correct? Let's move on over to the market internals and take a look at what's going on from this perspective. If you're not familiar, this is always Exhibit A for supporting evidence. Check out the video tutorial in the top right-hand corner. So we're talking about a sell-off on Friday. Let's actually evaluate how were the market internals on Friday. Were they, oh my goodness, markets are going to zero, or were they a little bit more neutral? Well, volume flow is certainly neutral. On the week, they're neutral. The advanced decline line did move to the zero line, but from nearly trend higher zone off of the open. Notice into the close, a little bit of an uptick here off of the zero line, not closing the day negative. And the cumulative tick does speak for the actual action of the market, which does confirm a little bit more bearish activity. So when I'm looking at this collectively, all of the data points in unison, I would have to make the assumption that, yeah, there's some stronger sellers at the exchange level, but are they panicking to the degree where, oh my goodness, the monthly trend is about to flip to down and we're going to crash off of lows? Absolutely not. Volume flows and again, advanced decliner, a little bit more neutral on that front. Let's move on over to the market profile and see what's going on with this supporting evidence. This is always Exhibit B. If you're not familiar, check out the video tutorial in the top right-hand corner. And what happened with value and the point of control on Friday is also fairly telling for more of that neutral data point. Now, this is not the bullish divergence I was referencing in the intro, but here is Friday's value and point of control. Did it migrate lower and sort of down towards the bottom end of the long-standing balance over here? As we can see, the point of control was actually still over the long-standing multi-day balance range behind us. So as I'm trying to juggle and evaluate the data points, weigh them appropriately, I think we have to acknowledge the change in character out of the market. Absolutely. It's clearly a rejection off of that all-time high. But did the sellers really damage the market? When I think about the severity of the selling pressure, is there something that we need to panic about and say, oh my goodness, let's really start dialing back positions. Let's swing for the fences with shorts, second mortgage of the house going all in, 0 DTE puts every single day of the week? No, we're not there yet, and it really is going to require the breakdown below the balance range with a lower high underneath if the market is going to be more sustained in the downward direction. One of the things I also find interesting here is that we did repair the poor low from Thursday's session on Friday's breakdown, and on Friday's low of day, you can see M period also leaves behind a spike. So early on Monday's session, spike rules will be in play. If you're not familiar with spike rules, let's go through them very quickly. If you open over the spike, these sellers have been rejected and markets should auction back towards the top end of the balance range, getting you closer to 55.60 on the ES. We'll go back to the SPY chart. I'll give you that number one more time in a moment. If you open in the spike, and by the way, the spike base, which is technically right here, is at 55.27. 55.27, okay? So if you open above, auctioning higher, 55.60 is the target. If you open inside of the spike range, if I could just recenter that, then we're neutral here and we're just looking for reactions at either end of the spike. Obviously, your low of day from Friday is 55.10. That's the base of the spike down at the lows, right? If you open underneath the spike low, if we open on a gap down on Monday's session, I would be thinking about continuation to the downside. And why would that be the case? Well, not only is it sort of, spike rules would tell us that the market's trying to auction lower, but now we have all of this overhead supply from the massive balance range up here, right? Any traders from this area, if we open on a gap down, are instantly wrong on Monday. If we have buyers who want to sort of close shop and say, you know what, we're We're going to wait for, I don't know, earnings. We're going to wait for Jerome Powell. We're going to wait for whatever it is that they want to wait for, and they're going to close long positions. That's adding selling pressure. And once again, all of this is going to act as overhead supply. So I think it's very straightforward. I think the levels are very well defined. Let's go back one time to the SPY cash. This is the equivalent of the breakdown underneath 55.10 on the ES futures, and over 55.60 would be the equivalent of 547. Those are the key levels. That's what I'm watching. Let's take a look at the nasty NASDAQ. So of course, beginning back on the monthly time frame chart for the NASDAQ, what do we see in terms of candle structure and location? Basically a rinse and repeat of the S&P 500 solid green-bodied bar, a little bit of an upper and lower wick. Same concept on the weekly, which we'll get to in just a moment. Strong close in the upper third. Bar-to-bar count does yield a massive higher low as well as a higher high, new all-time high close. Really nothing to complain about. Bulls on parade on the QQQ monthly time frame. One of the things I'm really thrilled to announce is that the cup and handle measured move actually was accomplished, right? So the pullback low of the cup and handle, that was yet to be hit as we were headed into June, and obviously that target has been achieved at 475. So there are two measured moves that we can start to focus on from beyond here. It would just be the cup and handle stacked on top of the cup, as well as the measured move from the bull flag when we look at it through the lens of something like this on the monthly. And lo and behold, both of those are the same. Closer to 525, we'll call it for round numbers sake, 520. Use that as a little bit of a zone. I'm not sure that this is within striking distance for the month of July. You'd really need a rinse and repeat of some of the strongest months we've seen in a very long time. And with sort of the summer doldrums in full effect, I'm not sure that that would be a wise target to really bank on happening. Like, you shouldn't structure trades that need the NASDAQ to move to 525 for you to be profitable here. I'm really thinking about options expirations when it comes to that. Let's take a look at the weekly time frame. We could, let's go back to the monthly just for a brief moment. We'll talk about retracements just because it is relevant, right? From the low up to the high, 38.2, previous all-time high looks good. Any monthly trend for a higher low can be sustained on something that looks like this, as long as we're over 400. We could take the more nuanced approach from here up to this high, and this is sort of in the midpoint of this weekly balance. Let's take it on down to the weekly now. Get a little bit more nuanced in the approach. One of the things I do want to highlight on the weekly time frame chart out of the QQQ NASDAQ is that the candle structure and the location is different from the S&P 500. It's not just that we have a green-bodied inverted hammer, which, don't get me wrong, there's still an indication of sellers stepping up here at the highs, but notice what happens on the lower low. Do sellers at all accelerate to the downside on the breakdown of the inverted hammer low, looking for a deeper pullback, perhaps a retest of this area down here? The answer is absolutely not, and there's actually a closure back inside of the previous week's range. If we had stronger sellers really stepping up in this market, I would have expected a weaker close out of the weekly time frame chart. It just simply didn't happen here. If we come in with a fib from the bottom of the move up to the highs, we know that the top end of the breakout point here is still very much so in play. Let's round that up on the weekly to 460. We'll get more granular on the daily in just a moment. We could check in on the weekly anchored VWAPs, and as we know, over time, that'll be confluence with that 460 area. That checks out as well. And of course, the volume profile wouldn't be complete without a quick look at that. I would argue that the lower bound of those weekly inverted hammers, it's still sort of a high volume node, but once again, the close back in the previous week's range, the lack of acceleration through the low volume void, I don't know that we have stronger sellers stepping up even on a higher time frame approach with the indication of a pullback looking like it's, I don't want to say like totally imminent, but wouldn't be unreasonable to get a little bit of a thin structure retracement through the body of that green bar over here. Let's bring it on down to a daily time frame chart for the NASDAQ now and really start to take a more granular approach. Of course, weekly expected move is up first. If we're contained by the upper bound, the number is up here at 486 flat, and if we're contained by the lower bound, 472.25. The daily trend, just like the S&P 500, is flipping to neutral inside of this zone. We did get an hourly downtrend back to an hourly uptrend, equal highs from up here and up here. But notice that we didn't actually close weak all the way back down on the lows, and that shouldn't be a shocker based on what we just talked about on the weekly time frame chart, the lack of closure below the previous week's low, right? So all set on that front. It doesn't sort of negate the fact that the daily inverted hammer here is quite nasty. It's still suggesting a bearish engulfment of the Thursday grind right here. And your key level out of the QQQ is going to be if this is going to be a double top, right? It's the low, it's the neckline of that pullback, which is here at 475.35. If you break down beyond that, we know that we're looking for a gap fill reversal here, or a test of that 460 zone on the weekly time frame chart, which is confluence with this breakout point from back over here. So we know how to traverse the time frames. We know what's being suggested here. If a pullback happens, that's fine. Remember, markets have give and take. Two-sided markets are actually healthier than one-sided dominated markets because you get better, healthier entry points for more sustained long activity. Let's drop it on down to a hourly time frame chart. We just looked at the daily, and we'll see what else we can learn. So, of course, the major pattern that's been in force in the NASDAQ has been this sort of inverted head and shoulders, and the neckline, it did actually yield a breakout early on in the Friday session, and I would honestly say that there was probably there was a decent amount of buy-side breakout pressure there, just noting that there was no rejection underneath this as overhead supply, right? A stronger sell-side market really would have just yielded like, okay, you're trying to break out, rejected, straight back down to the lows, big failure of the inverted head and shoulders neckline. But instead, you can clearly see we at least made an equal high. Now, it doesn't negate the fact that, once again, the daily structure, the close is weak underneath the opening print on Friday. Anything going forward that suggests a lower high underneath 482.25 is kind of detrimental back in the downward direction. You're starting to build an hourly downtrend. Highs, lower highs, lows, equal lows, flush that on some sort of H pattern, and the next thing you know, the daily neckline is in play at 475.35. So 2 ways to get short here out of the QQQ NASDAQ. Any counter trend rallies into this level, that setup, again, it could just be a simple hourly inverted hammer, could be a double top, it could be a head and shoulders here on a 5 or 15 minute time frame chart that then breaks down, target the equal low 478. If the market continues to the downside, I don't know that I would be short directly here. You never want to be the sucker short dead on the lows, but any consolidation sort of builds this out as an hourly bear flag, and then a flush through the neckline, of course, which we've been describing so far as the major pattern, really gets something like this into gear underneath that 475.35. Let's check in on the anchored VWAPs intraday out of the QQQ, and it's almost a rinse and repeat, right? So you're going to get some entanglement around here. I would sort of think that, all right, early on in the Monday session, if there's an opening drive and this is going to reject off of the Friday anchored VWAP, great. 482.25, lower highs are possible there. So what would this mean to the long side? Obviously, let's talk both sides. Anything in here is, I would argue, bearish consolidation based on the failed breakout of the daily chart, right? But if we're going to flip to being bullish, it's got to be something that looks like this. Show me the higher low, show me the love up and over 482.25, and maybe we'll start to think about this. And I know we're sort of traversing a number of patterns at this point, but what would this turn into, right? Obviously, you're talking about a massive ascending triangle at that point. So could it be a Brigade bolt, higher low over 482.25, consolidation tightens into the apex, and boom, you get a breakout in blue sky territories? Maybe. It's a possible idea if we need longs, but it really requires this structure being recaptured. Let's take a look at the internals for the NASDAQ side of things. A little bit stronger volume outflows here, and that shouldn't be a shocker when we take a look over at the core list of companies. A lot of that is the Magnificent Seven, of course. Same concept out of the advanced decline line, moving lower towards the zero line. A little bit of negative action, but still closing back over zero. And the cumulative tick out of the NASDAQ actually is not that bad on the Friday session, leaving me a little bit more open-minded. And that sort of ties back to what we were describing on the weekly chart with the sellers really failing to go lower early on in the week with this breakdown underneath 478. This breakout point, right, this was really the Monday session, that failure to go lower is sort of being reflected on the back end of the internals in my view. It's just that we really don't have aggressive sellers like slamming everything and saying, let's get rid of it all, burn the ships, right? Let's take a look at the NASDAQ market profile for the NQ futures. This is a little bit different. I think it balances the data points once again, where you can clearly see that the value area and point of control, unlike the S&P, did not hold up over the key structure, right? Sort of your breakout point out of the inverted head and shoulders, if you were to just look at it through this lens right here, the point of control did not sustain some sort of close above. So a little bit more bearish out of the NASDAQ for that reason, paired with the balance of the weekly time frame chart, the lower wick, the failure to go lower on Monday. It leaves me in a neutral spot. I really think, just to summarize, I know this is getting a bit long-winded here, I think you've really got to be patient out of the NASDAQ. Oops, wrong level. You've got to be over this for your clean trades, and you've got to be under this, obviously, for your clean trades as well. Doesn't mean you can't pick off that lower high short here, but just manage expectations inside the bulk of the balance range with some of these conflicting indications. And our final index evaluation will be on the IWM Russell 2000 small caps, starting with the monthly time frame chart. Obviously, one of these things is not like the other. The small caps have continued to sort of be the problem child, but as we get through the smaller timeframes, you'll actually note that this is, hint, hint, the bullish divergence I was talking about in the intro. On the monthly chart, though, red-bodied hammer. So sure, buyers stepped up in the lower wick of the monthly range. They were able to push prices back up towards the opening print, but there was no recapture. Obviously, it's a red-bodied bar, so about a 50% retracement. It's not the worst thing in the world, but it's definitely not aggressively bullish. If we're thinking about location, we now have multiple inside bars on the monthly time frame, which of course is indicative of range compression. So looking forward, the ideal outcome here for bulls across the broad market would be a breakout of this range in the upward direction with some sort of clearance up and over loosely the 210 to 11 area, which we'll see on the daily chart in just a moment. However, is it all that bad on the monthly? I want to remind you of the concept we described in last sort of month's analysis, which is just that monthly trends have to start somewhere. Any trend has to start somewhere. So is it a good thing that this is a monthly high or low, all sustained price activity over the monthly 50 SMA? In my view, the answer is absolutely. And as we're thinking about the trend developing, remember that in here, the market was incredibly balanced. It made these highs equal highs equal highs, and lows equal lows equal lows. There was no indication of any progress whatsoever. So is this upper consolidation, because it is technically just going sideways in a newfound balance range? Is it progress on the monthly chart? I would have to answer that question with a yes if you're looking for bullish outcomes here. Let's bring it on down to the weekly time frame chart. I actually want to zoom out here and begin with the anchored VWAPs because I think it supports more of the higher time frame monthly look that we just saw. If you take a look at the cluster of anchored VWAP bands, it's really supportive of the fact that yes, these monthly higher lows are constructive. We've recaptured a number of the key anchored VWAPs and we're not just grinding around chopping through the midpoint of them, little time spent above, a little time spent below, a little time spent below, a little time spent above. We're making some progress. So I do want to reiterate that sort of indication here out of small caps. But if we just go back on over to a simple 50 SMA as well as 200 SMA, what do we see in terms of candle structure on the weekly? Now, again, one of these things is not like the other. What did we see out of the S&P and NASDAQ? Inverted hammers, a little bit nasty, right, with those upper wick indications, whereas small caps actually produced a indecisive doji, a little bit larger of a green-bodied bar. I would say the body is slightly larger than the upper and lower wick, but it's definitely not as nasty looking for a potential pullback. I would certainly frame it that way. The other thing to point out is that the close is back over the weekly inflection point, which is 200, right? After the nasty inverted hammer that we experienced now 3 weeks ago. So the fact that that didn't see aggressive follow through and really suggest the triggering of a weekly head and shoulders underneath the neckline, to me, is a pretty, stable indication out of small caps instead of an alarming amount of, okay, buckle up, look above and fail on the weekly/monthly range. You're in for a nasty time in the broad market. So far, actually holding up sort of better than I would have imagined, if I'm being honest with you. If we come in here with some Fibonacci's from the low of the move up to the top of the move, all of this is happening over the 38.2. And if we zoom in a little bit more of a nuanced approach, let's take the bottom of the new range to the top of the new range. We've closed right at the 38.2. A good progression here on the weekly time frame chart would be getting price acceptance up and over 202.57, which, as we'll see right now, let's drop it on down to a daily time frame chart, is very close to a key level. Let's go on over to the small caps and let's zoom in. So firstly, as always, we'll evaluate the expected move. Here it is. The upper bound is going to be at 206.32 and the lower bound is going to be at 199.46. The key level that we were just describing, which is loosely that 38.2 on the weekly, is right around in here and here. Notice that on Friday, unlike the bearish engulfers with the large and alarming upper wicks on the S&P and the NASDAQ, the Russell does the opposite. It puts in a lower wick that's actually a gap fill reversal over the Thursday high, over the 50 SMA on the daily time frame chart, as well as, most importantly in my view, back inside of the upper consolidation from here. Remember that we had already experienced look below, and fail, hit the top end of the range, and at an alarming pace, we sold off quite aggressively straight back down to the lows. One of the concerns I had with small caps was the upper wicks that were continuously rejecting not only the 50 SMA, but the bottom end of the structural range at 202, The fact that the lower wick gap fill reversal held over that on Friday is really, really constructive in my view, and this is the bullish divergence that I was describing in the intro of today's video. If the small caps here can sustain price activity over 202, I would dial back the expectations that the S&P 500 is going to fall off of a cliff and go to zero. Oh my goodness, weekly downtrend, monthly downtrend, panic. It's not going to be the case if small caps can sustain price over 202. Now, of course, if we're under 202 and back down over here, we've got to call it for what it is. We're not in a daily uptrend. We do have a resistance trend line that looks something like this. The threat, of course, is an equal low breakdown. So I would go back into sort of, I want to be cautious with my words here, not panic, oh my goodness, markets are going to zero, but much more open-minded to bearish breakdowns in the S&P if we're starting to threaten a breakdown underneath 199, which would be the loss of the weekly line in the sand as well. Let's take it on down to the hourly time frame chart. We'll get a little bit more granular here. I do like the fact that on the opening bar there was even a first initial indication that tried to find support over 203.25. Obviously, it was not very successful, but the fact that buyers are trying to step up does show me, okay, people are not totally giving up on small caps. If it was going to be Armageddon, oh my goodness, it just would have been sell side pressure, almost like what you saw back here, what you saw back here. There would have been no attempt for that lower wick off of this key level. Now, again, not out of the woods. If we are getting consolidation in here, I would be a little bit more neutral. If we fall underneath 202, this is bearish pressure for the S&Ps. Oh my goodness, bearish pressure, as we just described, underneath 199. If we're over 203.25, I think that's a saving grace. That's total optimism for your S&P 500. So small caps will be a guiding force for the market this week, is my belief. 202 and 203.25 are your key inflection points to really monitor more closely. Let's take a look at the market internals for the Russell Index, and you can see really strong volume inflows into the close of that Friday session as we were putting in that gap fill reversal bar that moved back in the upward direction. Same thing here out of the advanced decliner, never getting negative, and the cumulative read out of the tick really wasn't that bad. I mean, it's hardly negative, and it did spend the morning session a little bit more so positive, unlike the S&P and the NASDAQ, which were either flat or negative building throughout the day. I'm really thinking back to that S&P, right? If we finish up the Russell with a look at the market profile, what do we see out of the value area? Well, of course, value is here on Wednesday, Thursday up here, and Friday up here. It's a slow grind in the upward direction, absolutely, but the point of control was able to close outside of the Thursday high, sort of reinforcing the concept, to me at least, that the gap fill reversal was pretty stable, right? If you look at the top end of the Thursday range, it's actually an M period spike, right? So we already talked about spike rules over on the S&P, but concept still applies. This is technically thinnish structure. So the fact that the market looked through that and then was able to close back over that high, point of control wise at least, does strike me as, again, a little bit more of a constructive or just generally positive indication for the small caps. Let's get even more granular and start looking through our sectors. So we'll firstly evaluate their weekly performance, who was leading, who was losing, and where was the weight. The energy sector leads the pack up 1.81%, followed by communications and real estate, and I will include the technology sector up here because it's the only other green sector, up 26 basis points on the week. Really not a stellar performance there, noting that the market did go more so sideways than anything else, and we did attempt a new all-time high. The TLT is at the bottom end of the barrel, not an S&P sector, obviously, but in terms of risk on versus risk off, it's not like there's a flight to safety into bonds currently. XLB Materials is another laggard, as are utilities, as well as consumer staples. So at the bottom end of the barrel, it's not like we're seeing really heavyweight risk on sectors taking a beating as this market saw a pullback on Friday, but at the top end of the list, we're also not getting a lot of participation in the upward direction. Notably, financials kind of flat in here, down 56 basis points, the semiconductors ETF down 31 basis points, and consumer discretionary down 13 basis points. Let's check in on the structural charts and just evaluate what's going on here. The energy sector is in a bit of a downtrend. We've made note of this for quite some time now. Up against the top end of the channel, wouldn't be really much of a shocker to see a turnaround and a move back down towards the bottom. Your key level to watch just early on in the week is 91.75. It's such a lightweight component. It's not really going to push and pull the S&P by itself. The XLC looks great here. I mean, a new all-time high on the Friday session, breaking out over the top end of this balance range earlier on in the week. If we could spot a higher low here, that's very optimistic for the S&Ps. I mean, it's not the heaviest weight component like the XLK, like the XLV or XLF, but it's still a risk on component. So if this is hanging out up here, that does strike me as bullish. Even a deeper pullback into the range can technically find a higher low. I know we're sort of like pulling at straws here, but there would be a higher low over the bottom end of this balance from the daily perspective. So 84.10 is also okay. I'm not really seeing the argument in the sectors where it's going to be, oh my goodness, Armageddon. Real estate, really lightweight sector. It's still over the top end, or I should say it's over the level rather, that was acting as the weekly double top neckline. Here's the XLK. Big failed breakout over the multi-day highs on Friday, but once again, was this run impressive? Did it make a new all-time high? Is it pulling back? Is it okay to spot a daily high or low? All of those answers are still very much so yes. So although this is an inverted hammer, although it's a failed breakout, I'm not again, panicking, oh my goodness, markets are going to zero. I think you could easily see a rotation back to these lows and maybe some sort of gap fill reversal out of the XLK starts to get interesting. Obviously, intra-week, that would imply some bearish pressure for the S&Ps, so we'll take it one step at a time. As we come into the gap fill reversal, I would change my tone in the S&Ps to say, okay, are we at a location where the daily can either sustain a higher low in that balance range, or could we get a weekly higher low if it causes a breakdown of the double top neckline that we focused on so much in today's episode? Here's the TLT falling off of a cliff on that Friday session, still over the trend line here, and you could probably also make the argument that it's over a support trend line anchor, touch one, coming into the cluster of moving averages. Not the end of the world here, as long as it's sort of, I would argue over that support trend line. Next up, we have materials, threatening the neckline still. It's such a lightweight sector, we're moving along. Utilities, mild pullback over here, lightweight D for defensive sector, not the end of the world seeing that pullback either. Next up, we've got consumer staples. It's still stuck inside of a balance range. This is weekly compression. Can't really call it bearish until it clearly breaks for a lower high underneath. Now, it certainly can't imply that it's bullish pressure for the S&P 500. I mean, it goes both ways, but if anything, it's just more so neutral. I don't think it's fair yet to say we have an outright breakdown across the broad market. Industrial, same sort of concept in here. Balance range, yes, we're sort of hanging out in the lower third. We do have sort of lower highs in force like this. I just really keep an eye on that 120.40. If it makes a new swing low, that's where we're concerned for bearish pressure. Here's the XLV. This is helping bulls and bears. That's the argument we've made over the past couple of weeks. It's stable. It's inside of this range. It's technically D for defensive, but it's also fairly heavyweight. Market's not going to fall off of a cliff if this is hanging out up here. Next up, financials. Same commentary, right? Markets can't fall off of a cliff if financials are sideways in the midpoint of a balance range. Now, I will concede, and I'll always give credit where credit is due. The Friday bar is not really all that enticing, right? We have a rejection in the upper wick of the daily 50 SMA, the midpoint of this balance range at 41.20. If it rotates back to the bottom, it's highs, lower highs, sort of equal highs. If we come back down into these equal lows, that breakdown has me more concerned. We're just not there yet. So I will give credit to the sellers for possibly forming a lower high here, but we're not totally in cahoots yet, and I'll show you why on JP Morgan in just a moment when we get to the core list of companies. Semiconductors, rinse and repeat of the XLK commentary. We're okay as long as we're over this 255.70. We're okay on a daily higher low. If we're over 243.50, we're okay on a daily higher low up against 237. Daily 50 SMA intra-week, yes, bearish pressure if that breakdown does take place. And yes, we will watch for that key level to break in the S&P 500, but if that doesn't happen, if we're just sort of sideways in this range, if you notice that the SMH is still over 255.70, I would not be trying to hit a grand slam on a short-sided trade in the S&Ps. XLY, more progress being made over here, higher high on Thursday and Friday, pulling back, grinding along in this upward channel. Ideally, it sort of supports around Friday's lows. 182 stays over the top of this inflection point from the past one. Sort of interactions here, 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 here. You can sort of see how visually that is an interesting level out of this chart. So any consolidation over 182, this is a heavier weight S&P sector and definitely more risk on in terms of nature. Let's take a look at the ratio grid. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. As you can see, the XLK continues to be the glue that holds the market together. I would love to see a double bottom out of the XLF ratio, but even still, we're sort of at odds with the daily 50 SMA rolling over here, more of a battleground for a potential lower high, but improvement would still be healthy, at least intra-week. And if you notice this sort of outperformance, if you notice the XLF sideways in its range or even threatening a move back up to the top, you probably want to dial back those short expectations in the S&P. XLY, not great rolling over for a possible lower high underneath the 50 SMA. So again, it's still mostly the glue up here in the XLK, but one step at a time. I would not consider the market outright bearish yet. We don't have risk-off indications, same thing here and same thing over here. If we check in on the specialized ratios, basically a rinse and repeat of the same commentary. This is still bullish. We could take a look at this one. Still bullish, trying to make that equal high and possibly handling for a breakout. The XLY apples to apples with the XLP looks great. Like this is actually more of a risk on indication as that XLY continues to actually perform. So again, not an Armageddon situation for the broad market currently. A little bit of a pullback through the tech sector is going to cause some strife, but hey, two-sided trade is welcome in this market. Semiconductors versus the healthcare sector, still okay here relative to the uptrend that we're in, trading near those highs on a higher low pullback. Let's talk about the dollar. It's sort of, mellowed out into the end of the week, not really doing much, going sideways in here. The most interesting thing this week would be, okay, do we continue to consolidate and break out? That would be downward pressure and align nicely for a pullback in the S&Ps. If this breaks down, right, if the dollar's under 105.65, probably just looking for a more sideways S&P. We'll take a look at the gold contract to see if we can get any insights in here. Gold did not break down underneath the 2300. It actually rebounded higher on Thursday, Friday. So the big watch would be, is this still going to yield a lower high here? Or if we trade back into the equal high, and that level, just to give you a number, is at 2375, we'll call it for round numbers sake, 2375, and the dollar is, I don't want to say finished, but it's probably a bit more neutral and not going to aggressively break out in the upward direction. Let's take a look at interest rates. They did tick back higher, but as we know, we've broken down through 43.33. We got, I would say, decent PCE on Friday, nothing out of the ordinary. We're like, oh my goodness, inflation's going to rebound, right? You're still getting these big time lower highs out of interest rates. This, again, does not strike me as an end of the world situation for the S&P 500. Let's move on over to the inverted ZT, taking a look at the expectations of the Fed. Small move in the upward direction, but really nothing to write home about. We can actually just move directly into the Fed tracker tool, and virtually no change out of the odds for the July meeting. It's at the end of July, so there's plenty of time before that's going to act as a direct catalyst, and we're still sort of, the market's at odds with the Fed's SEP, still pricing in 2 rate cuts into the end of the year. Remember that rate cuts, typically leading into them, the market's going to rally, and then as we know, if this is a panic situation, the Fed's hitting the eject button, it's generally not going to bode well. You can look at the historical charts for when a rate cut happens. As a matter of fact, let me just show you over here. That way nobody is confused, right? So let's go on over to the Fed funds, and you can see every single time there's a red line. If we just zoom in, so this is going to align. This is a rate cut. If we just switch to the, all over the place with the keyboard shortcuts, bear with me, folks. Thank you very much. Rate cut, rate cut, rate cut, rate cut, rate cut, right? Market pulls back, market pulls back, market pulls back. The most notable ones that everybody references, of course, is the dot-com crash and the great financial crisis. So it doesn't mean that the market needs to go to zero. It doesn't mean that we need a rinse and repeat of what's over here. But generally speaking, right, when we're sideways, the anticipation of the rate cut continues the market to rally in the upward direction. When the cut happens, generally that's when the pain starts to happen, because the Fed is responding to an economic condition, aka recession, that they're trying to dig us out of. Anyways, back on over to the technicals, or excuse me, the fundamentals. Let's move on over to a little bit of a Bloomberg terminal indication, courtesy of Liz Young-Thomas. Thank you very much. But PCE continues to roll over. So as I'm thinking about the data points that came out last week, I don't look at this and say, nope, it's got to be higher for longer. The Fed's going to threaten, hiking rates. Bowman has sort of been off her rocker, suggesting that that's the case on Tuesday and then again on Friday. Just unbelievable. But PCE continues to rotate in the downward direction. I think the most notable thing here is that durable goods are deflating, right? Obviously, and you can clearly see the progress on non-durables. I mean, there's a little bit of inflation here resurging out of the non-durables, but certainly not to the extent which we know services is still such an issue for this market currently. If we take a look at some of the other data that came out last week, the GDP came in just fine, just directly in line with the expectations here, no issues there. The unemployment claims came in better than the expectations. However, we've got to be mindful that just because expectations moved higher and we came in lighter, it still means that, we're getting an increase in initial jobless claims on a week-over-week basis. So this upcoming week, and here's the PCE, by the way, that's the actual read on the month-over-month core. The upcoming week, if we just take a look at the data that's scheduled to be released, it's the labor report week, right? We know we're getting jolts. Looks like Powell is going to speak on 9:30 Tuesday morning, directly as the market's opening up. That should make for a fun time for us. ADP non-farms, unemployment claims, and this is where, so on Friday at 8:30, I don't know if we'll be at the desk. I don't know what's going to go on with Friday, July 5th. Again, Wall Street's taking the day probably. I don't know if we will as well. Maybe we'll just tune in for the data release and see how the market sort of responds. But generally, wouldn't be a shock like this right here, whereas the unemployment rate staying stable at 4%. I don't think that that is a reasonable outlook. I would generally look for that to increase by at least 1/10 of a percentage point. So that is Friday at 8:30. As we look forward to earnings, basically a snooze fest this upcoming week. Obviously, that's the way it should be with a holiday on Friday. We're sort of through the majority of Q1 earnings. Q2 is going to accelerate towards the end of July and even early August. Let's move back on over to the charts, though, and we will take a look at risk appetite, TLT relative to the S&P. I did want to point this back out because we know that it was a bit of a threat back here, trying to build an uptrend, no longer really an issue and not a shocker considering that Friday bar. If we move on over to bonds relative to themselves, they're still technically in short-term downtrends with highs, lower highs, lower highs, lower highs. Same concept over here. This speaks to duration risk. As long as they're pointing down, that is more bullish for equities down below. No big issues yet in terms of a trend reversal. What about credit spreads? This medium term continues to drift higher. We're keeping an eye on that. I've got to admit, this in my back pocket is something that I'm considering and saying, hey, if this starts to get out of hand, is that going to be like the silent killer that brings down the market? It's something to pay attention to. I would really want to see confluence with both of them aggressively moving in the upward direction. We're just not there yet. Let's take a look at the HYG in isolation. This, of course, aligns quite nicely. We know that the market has been divergent to junk bonds. If this breakdown through the low happens in the HYG, wouldn't be a shocker, or it shouldn't be a shocker if the market also follows suit with a move through the neckline as described on the double top from the daily time frame chart. Bitcoin, what do we see? Did we break down? Not yet, but starting to build out a bear flag down here. Just not much of a counter trend oversold reaction off of that 60,970. So keeping an eye, if this breaks down as well, would further the narrative that, okay, maybe the market also pulls back as a risk off indication. What about new highs versus lows? You want to talk about a bullish divergence. We certainly saw an uptick out of this. And again, it's not that it's aggressively over the zero line, but we're certainly not sustaining big movement in the downward direction. So breadth, I would argue, is stable. It's not stellar for the move that we've seen up towards the all-time highs, but again, not deteriorating is the key component there. Breadth usually, just as like an FYI, just because breadth is not aligning with the market, technically, it shouldn't be at all-time highs. Usually the market catches up to breadth. The market doesn't break down because breadth is overly aggressive. So it doesn't mean it can't happen that way, but I would say, maybe 7 out of 10 times it happens where the broad market catches up to breadth, right? Let's take a look, or I should say the breadth catches up to the market. You see improvements in the non-heavyweight components of the market, right? SPXA 200R, still stable up here. The reason I want to continue to check in on this is just noting what's happening with the SPXA 50R. So stocks are not really aggressively trending in the downward direction. They're really more so going sideways. 50 SMAs are catching up, but 200 SMAs are still well below us if we're looking at the spread between those two. Let's move along to the RSP equal weight. I think that this is totally in alignment with our key level out of the S&P. If you drop the 163, that's been the key level in the RSP, then great. Wouldn't be a shocker to see the market also underneath the neckline over here. Nothing new to write home about. On the QQQE, same concept, no new high. All good. Again, not really thinking into these too much. And then we can move directly into volatility. No changes out of transports. Stable at the lows. VIX is going to zero, bro. Same thing over here with the VVIX. Right back down to the lows. Not really accelerating on that Friday session. It's not like we made a new swing high out of the VVIX. Duck and cover. Not the case. The volatility futures still in a strong contango. A little bit of a creep here out of the one-day VIX, but certainly nothing to write home about. Still below that 1275. Let's move into the core list of companies here, beginning with Microsoft. What do we see? We're still on daily time frame charts. There were some pretty aggressive end-of-day sell-offs, and what did this do on the daily? It certainly broke us down into these lows. If there is going to be a retracement, this breakout point is a top watch for a daily higher low, or even anything like, this is a daily higher low, this is a daily higher low. I'm really interested in pullback longs out of Microsoft coming from this all-time high. A little bit of push and pull. Let's take it down to the hourly time frame chart just to once again sort of look at where the selling came in. Majority of the day is neutral. It's actually staying stable over the top of the ascending triangle. It's the end of quarter, end of month, end of half, portfolio rebalancing type of sell-off activity here. It doesn't really strike me as like, oh my goodness, everybody all day there was some catalyst. Let's get rid of Microsoft and let's really just like get out of these stocks. It's more so a rebalancing look based on the end of day sell-off. And you'll see the same thing over here in Apple, right? Of course, the pattern that we're trying to navigate is a pie in the sky inverted head and shoulders. If we can open up on Monday's session over 212, I would still keep this in play. And of course, the break is over 215 to the all-time high, 220, 219. If we're down here and consolidating, so the sell-off is like, no, people don't really want to get back into Apple after rebalancing. We'll just keep it as as is, the sell-off, or I shouldn't say the sell-off, but rather the breakdown that you're interested in is the lower high underneath 209.25 to get into this little congestion zone down here. I would watch out for that on Apple. NVIDIA, skipped one, NVIDIA. Let's take a look at the daily time frame. So you are getting a little bit of upper wick activity Thursday and Friday, but you're still over the key balance point from back here. So as long as you're over 122.50, 121, wouldn't throw in the towel. If this is going to act as a big time lower high, equal low flush under this level, I would start thinking about, okay, bottom end of the balance, the gap structure here, this earnings gap down here, the daily 50 SMA. So your larger breakdown in NVIDIA likely comes out of some sort of head and shoulders. Apologies for the whistle there. That's going to be underneath 118.25. So your larger shorts, 118.25 hourly time frame chart. Notice that this did not see a rebalancing sell-off into the close. Instead, it's really more so balance rules in force. If you snap the lows, great, expecting this equal low here. That's the neckline we were just referring to. If you're inside the range, not much to do. Breaks and higher lows over 127, you know the drill. 133 is the big target that I have for NVIDIA. Next up, Google. What do we see? The end of day liquidation, check the box, absolutely. Breaking down, so the name of the game here is actually to spot the lower high underneath 182.75. If you can short it, great, don't overstay your welcome, but there is a short available into 180.60, and then I would look for pullback longs into that retest. So this, and then double bottom, hammer candle, inverted head and shoulders, the whole 9 yards. 180.60 would be that possible daily high or low. You could argue for a weekly high or low over the top of the balance range here. Something that looks like this is still in play as well. That level is 178.25. Next up, Amazon. End of day liquidation. Yes, let's go on down to the hourly chart, as well as a sustained downtrend intraday, sort of reversing, I wouldn't say a majority, but a decent chunk of that breakout from the Wednesday session. As we look forward, I would really want to see the hold over 191, the daily time frame chart here. As we were tracking, there's everybody's sort of ascending triangle, everybody's grandmother's second removed cousin's goldfish was watching this pattern. So the retest of 191, pullback longs are a possibility there, looking for continuation back up towards these equal highs. So how do we pull it off on the hourly? Sustained pullback, you start to get an oversold read on the hourly chart. You can start looking for this, and then the Brigade bolt over 193, this consolidation in the afternoon of the Wednesday session. Let's move along to the metaverse and see what's going on with Zuckerberg's Fantasyland. There's your end of day liquidation. Back down towards, I would argue, really the choppy component of this balance range. So for over 501.25, I don't know that I'd throw the towel in on the long side. I would be a little bit more long biased, looking for a retracement back to the top of the range, and definitely more long biased on this back over 514. This breakdown into the end of day really changes my tone to being a bit more neutral. Again, classic pattern traders out there are probably saying, nope, look above and fail, lower high, target the bottom end of the balance. That's the trade in store. So, there's two ways to play it. You could either be optimistic and wait patiently for this, and you just miss the short trade if you sort of are unwilling to participate on a lower high here, or you try to participate on the lower high, you aim for the equal low, and then follow through to the bottom end of the balance. If you could spot the risk reward there, I think that probably offers a better situation, but you'd probably also want a broad market weakening, not strengthening, if that was to continue here out of Meta in the downward direction. I know the key question is does the dog wag the tail, or does the tail wag the dog? So anyways, Tesla, it's getting in gear. It's trying to wake up. I will acknowledge, of course, the breakout from the Wednesday session. I like the consolidation that's high and tight. The end of day liquidation sort of was bought back up, and I like the hold here at 194.75. I'm sure you'll know exactly what I'm about to say. As a pattern trader, as someone who trades hourly trends and daily inflection points, right? That sort of immediately comes to mind. So if we're getting lower highs underneath 198.85 and then we break this neckline 194.75, I'm totally looking for a thin structure retracement and then the exact inverse down here. Can we get a double bottom? Can we get a hammer candle? The classic indications. There's your inverted head and shoulders, and that level is at 188.50. Any consolidation up here that does not break the neckline or even Brigade bolts over 198.85, your next big target is the daily 200 SMA here at 206.25. Beyond that, I think it's 213. No. 231. I had the numbers reversed in my head. I knew it was threes and ones, but man, 231.25 daily time frame chart, just so we can really come to terms with that target. That's the flush point from this overhead supply, right? This is where the market really accelerates to the downside and gets worse on the earnings call there. You could probably make the argument that there's likely a level at 215.60s, 215.75. So you could include that on your chart, but generally speaking, I want to be aware, so I'm going to leave it off on mine, that there is some range to trade for overhead there. Next up, JP Morgan, what's going on with financials? And this ties directly back to the XLF, right? Inverted head and shoulders. I like the break on Friday up and over $200.75. This is totally, it's telling me at least that there's some degree of market rotation taking place. It's not sell everything. Oh my goodness, panic, sell it, sell it, sell it. No. Look at financials breaking out. If we're over $200.75, this is bull flag. It's constructive over your neckline, which would have looked like a trend line, something like that. So beautiful, beautiful move. I like the move back out of this. So it's a balance range break paired with a break of the daily trend. You now have lows, highs, higher highs. So higher lows are on tap. Again, there's that key level and looking for upswings into 204.25. Here it is on the hourly. And you can see that the consolidation was fairly healthy into that afternoon on Friday. So I would give it leeway. I would say more important than the $200.75 is $199.75, acting as sort of the top end of this, either as a range, or you could come in with a trend line and call it an ascending triangle. Shorts will really have more of the upper hand as a failed breakout on a lower high under the $199.75. Netflix is up next, double top. Let's go to the daily so we can see that a little bit more clearly. Double top possibly brewing with a thin structure retracement into the breakout point at 656. Let's go on down to the hourly now that we understand that context. And here it is, daily double top, neckline break, thin structure retracement from back here, 656 target. So that's an idea. I would not be short Netflix inside of this range up here. I would be short Netflix on a lower high under 673.75, looking for that rotation into the low. In here, I think it's choppy, and I think we want to be patient for the break over 687. We know that Netflix has gone on these really sporadic moves recently. You want to be patient for this into the all-time high, $700.99, 1 penny shy of the round figure. AMD, daily time frame chart, ugly, hideous, inside a balance range, nasty upper wick on Friday. What do we see? If I'm thinking about this chart objectively, we know that this balance range has been pretty tough. We saw the breakdown here, no lower high underneath. We saw a breakdown again, no lower high underneath. But what did we want as longs, right? We talked about this on Friday's pre-market prep. We wanted the higher lows over 162.75, no dice on the Friday afternoon pullback. So the breakout in the morning was great. Show me the higher low. We'll rotate to the top end of the range. No go. Try again next time. So the lower high underneath keeps me a little bit skeptical. I'm more neutral on AMD, not really looking for follow through based on that activity. All right. 4 trade ideas for you, and then you're on your way. AVGO, what do we see out of Broadcom? Back into the semiconductor space. Notice that we have an earnings gap below us, and notice that on Friday we test the low of the earnings gap up, inverted hammer, nasty upper wick. So any sort of breakdown underneath these lows, let's bring this in at, let's go 1570 for round numbers' sake. You guys know the rules up here in the penthouse. Under 1570, looking for the gap to continue to close. This is nothing more than a classic bear flag, daily inverted hammer, upper wick gap up bar in the first place. I'm watching, right? I'm really watching. 1570 into 1507, plenty of range to be trading for. We'll see how that one potentially pans out. That's AVGO. Next up, sticking with the theme of these more popular names, SMCI. Let's take a look at this one. Bullish or bearish? Hate to tell you, but it's actually bearish as well. Noting that we had this break on the gap up, right? But it didn't really sustain price over the top end of these two equal highs. So if we're thinking about a daily range, first of all, we're sort of towards the midpoint, but as you can see, based on the level I just drew in at 815, all of these lows are very precise. From here to here, you have a daily lower high. You have a bearish engulfer on the Friday session as an actual structure. If you flush these lows, I think it's a rotation to the bottom end of this range, if not just the bottom end of the daily balance at 708. Here it is on the hourly time frame chart. And you can start to see if this was an hourly double bottom, great. Show me the higher low above, 850. Obviously not the case, and look at what happened into the end of day. Lower high underneath. So consolidation here, breaks lower highs. This is your first rotation. 708 is that further downside target as well. If it's consolidating up here, I would take this one off of short watch, and that is SMCI. Next up, we've got MasterCard. What's going on with MA? This is obviously a pretty heavyweight contender in the XLF, moving over from the XLK. That feels like eons ago, but flush point in play at 440, and we know that that should not have 3 pennies. It should be the flat figure. So under 440, looking for the breakdown into this breakout point at 426.65. I'll be willing to bend and flex there. That's close enough. That's the target. Right now, the reason that I included this as a setup is because if you look at a counterpart or a competitor like Visa, it actually broke down aggressively already. So is MA the lag? Also break down with Visa here? It's definitely a possibility and something that I'm keeping on my radar for this upcoming week. And then last but not least, as we move towards things that are more obscure, GDDY. This is a rinse and repeat of a prior trade idea. Again, this was just a very simple bull flag up here for quite some time. Failed break to the upside, failed break to the downside. I like the relative strength on Friday, not really yielding that nasty, end of day closing sell-off. So if we could take out the top end again, I'm just thinking about another attempt for a continuation play in the upward direction. Small hourly traders are thinking about, cup and handle here. So over 140 territories is the name of the game. It's not in play if we're getting acceptance underneath 138.15. We're going to end it on that note. Thanks for coming out to the show on this weekend's update. If you learned anything new or enjoyed the video, let me know down below in the comment section or by giving the video a very simple thumbs up. We will be live up in the penthouse for the pre-market prep on Monday at 8 o'clock, and we're going to get it on the design department to see if they can update the little label in the top left-hand corner. We hope to see you there, and remember, markets will be closed on Thursday. Don't expect a stream on 4th of July morning. And we'll keep you updated throughout the week as to whether or not we will do something on Friday or if it's just going to be a day off. With that said, have a green trading week, and I will see you next one.